and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, real estate, insurance, loans, equity, and everything else about your money. We, of course, would love to make the show interactive, so we'll be more than happy to hear from you about all the questions and queries you have regarding your money, and we'll happily take them up with our experts. But first up, it's time to take a quick look at the top headlines that we are tracking this Thursday evening. It was another weekday of losses for the Lal Street. The Nifty closed at that 23,315 mark, which is an important level of support coming in for the Nifty. Broad based selling was obvious on the street. Bank Nifty as well tested its 200-day moving average, touching and trading below levels of 50,000 briefly before it made a sharp recovery to close above those levels. The Nifty remains a sell on rally with bears initiating fresh longs or rather fresh shorts at every rally on the street. Well, the Nifty did close at a 5-month low and dropping 168 points to be precise. Well, the equities have had it down and out. It's Bitcoin that continues to make new highs and now to trade just below $95,000. Following news that Donald Trump's social media company was in discussion to acquire the crypto trading from Bakkt. This development has raised hopes for a more crypto friendly approach under Trump's upcoming administration. Bitcoin has more than doubled in value this year. It recently traded at 93,709, up 1.6%, after reaching a record high of 94,982. According to reports, Trump Media and Technology Group, which runs Truth Social, is nearing an all-stock deal to buy Bakkt. Bitcoin's price has climbed more than 40% since the US presidential elections on November 5th. Well, those are the two top headlines that we are tracking. Beyond that, the markets, of course, continue to remain under pressure. But like we said, this is a show about personal finance and all about your money. Today, we have a very interesting conversation aimed at all our young audience that we have. In fact, Gang, CEO and co-founder at Moneyfront, joins in to talk to us about a topic which is close to my heart and a lot of people's heart, which is money made simple for you if you're in your 20s. Mohit, good evening. Thank you for joining us this evening. Mohit, this is, of course, aimed at all a young audience that watches us and is seeking advice. It's a big world, it's a big universe, it's very confusing, it's very intimidating, but money should be made simple. And I think that is a good starting point if you want to inculcate the habit of saving and then, of course, investing. So, if a 20-year-old asked you, Mohit, where should he or she start their financial journey? What is the first actionable step to undertake?
Hi, Samina. Thank you so much for having me on this show. So, look, I wish and I could go back and fly back in time and start my journey at age 20. Unfortunately, I think as I look back, I have that small regret that I started pretty late in my life. I started at an age of 25 when I started investing. But that difference of starting at 20 and 25 could be massive. And as we chat through this conversation, I will try and put some numbers out which will kind of highlight this stark difference. But first things first, from how should someone at age 20 start? I think at that age you've started thinking about money and savings. That's the first right step which you have taken. The second thing which you need to do is whatever pocket change you have, whatever money you are earning or your parents are giving to you, you have to carve out a portion of that. That could be 20%, 30%, 40%, and go into a savings instrument. Now, whether that savings instrument is a fixed income instrument or is an equity instrument, that again depends on how you want to be. But at that age, I would assume so that you can take all the risk in the world and you have to start investing gradually and steadily into equity instruments. And those instruments need not be complex at that age. As you start, the first steps towards financial independence has to be taking very small and starting to invest into a normal equity mutual fund. So my sense would be that you start with 20-30% savings and start investing into an equity mutual fund. That's the first step at age 20 which you need to take.
Mohit, more than one reason I would also want to go back and live my 20s, right? You're footloose, fancy free, very few responsibilities. You've just discovered financial freedom. You're just right out of university, had your first job, money is available. Like I said, responsibilities are limited. But let's start simple. The first thing I would imagine if you're 20, 30, 40, 50 is to create a monthly budget. I think before one starts saving, one needs to know how much one can save and how much one spends on necessities and what is, of course, discretionary. Are there any practical tools or techniques or apps that you recommend that young people can use in order to create their monthly budget?
Yeah, absolutely. So look, I think the first step is to change the equation of your life. Typically what happens is, Samina, for many people around or investors around, even at mature ages, even at later stages of life, I have realized that the basic equation is wrong. And the equation which people typically follow is income minus savings is equal to investments, or income minus expenses, my bad, income minus expenses is equal to investments, right? But means that whatever income I'm earning, I will put out my expenses first, and then whatever is left out, that whether that be 10 rupees, 20 rupees, in proportion of my income, I will then start investing. If we correct this equation and change it to income minus investments equals to expenses, then the entire life gets streamlined at one go, which means that whatever you are earning at that age, which is age 20 or 25, whether you're earning 100 rupees, 1000 rupees, 10,000 rupees, or a lakh rupees, you first carve out what will you invest. So income minus investments is equal to whatever is left out. You then try and run your expenses within that framework, right? So you have to first change the equation of your life. Once you've done that, then what is the basic ground rule for it? The ground rule is 50, 30, 20. What does it mean? It means very simply that out of whatever you are saving, right, or your total 100 rupees of pot, 50 rupees will go for your necessities, for your needs, for your daily expenses, which could be your rentals, your EMIs, your college tuition fees, your expenses, your daily bread and butter. 30 rupees could be discretionary expenses, which is more of your wants, which is more of your luxuries, which is more of your travel, movies, entertainment, clubs, hotels, or whatever it be, right? And the remaining 20 rupees has to then go out for investments, right? Which is a concept which is called pay yourself, or give yourself the first check, right? So that 20 rupees is about yourself. You have to invest for yourself, invest for your future, invest for your retirement, invest for your dreams and goals. So that 20 rupees has to necessarily go into investments. But I think the starting point is changing the basic equation of life. If you do that rightly, you never go wrong in the process of investments.
Hmm. Well, in that case, would that be your golden rule in terms of advice to our viewers in order to save or invest in their 20s?
Oh, absolutely, absolutely, right. Nothing else can guide you more than that one simple equation, which is income minus investments is equal to your expenses, right? You need not put the expenses first. You have to put the investments first, which is the most critical part. Early bird catches the worm, right? And as I told you, Samina, I'll put out some examples for people
Yeah.
to realize how critical it is. If I start at age 20, and my goal is to create a corpus of 10 crores by my age 60, which is my retirement age, or which is when I would like really want to enjoy the fruits of my labor throughout, right? I need to start at 8,400 rupees only if I'm starting at age 20. 8,400 rupees put out as a monthly SIP growing at 12% rate will lead me to a 10 crore corpus at age 60. If I don't start at age 20 and I start at age 25, then the corpus requirement or the monthly SIP requirement is not 8,000, it goes up to 15,000. But if I start at age 30, which is when most of us realize that we need to start saving, then the requirement is 28,000 rupees monthly. And God forbid, if you are in that portion of the population which starts at age 40, then the monthly requirement to reach a corpus of 10 crores is a good 1 lakh rupee of SIP, Samina, right? So this is how power of compounding works. If you don't start early, if you don't start timely, the catch up is extremely difficult, extremely arduous.
Well, Mohit, thank you for using that example because I think that really drives the point home for a lot of us, right? But it's always consistency over intensity, and I think that's the most important advice given to us, and what we give young people as well. And hence, making savings a habit is more important than doing it once every few months, even if you do it intensively in that sense. Can you tell me why you believe as well that making saving a consistent habit is critical, and how does one do it? How do you make it non intimidating in that sense?
That's a great question, Samina. Look, honestly, I'll go back to my times when we were small and we used to watch cricket. There were two great players who came into Indian cricket arena at that point in time. One was Sachin Tendulkar and the other was Vinod Kambli. Both were equally talented. Both grew up together. Both had equal amount of talent. And in fact, many believe that Kambli was a naturally talented left-hander and much more superior in his style and technique than what even Tendulkar was, right? And both of them erupted on the Indian cricketing scene. However, one lasted for eternity, one lasted for a good 25 years, and the other one fizzled out in around 5 years or about that much time, right? Uh, who is considered the great? I need not answer that. I think you and I and everyone around knows that Tendulkar is the greatest of all times in terms of cricket parlance. And what made him great was not that he was much more talented or much more superior or a master stroke player or something. All those qualities were of course there, but he was the most consistent and the long lasting player, right? The longevity, the consistency and the longevity gave him that tag of greatness. And if you go around any field, whether be sports or whether be investments, the people who are great or who make it big in life are the ones who have actually slogged it out for many many years and consistently are doing the same process day in and day out. So that's why we say that if you start early and you repeat that process of systematically investing day in and day out, month in and month out, right, you will start reaping the benefits of it pretty soon. I'll again give one very small mathematical analogy out here. There's a very good formula in personal finance, and it's called the formula of 853. Right? What does it mean? It means that if I were to first make my first crore, let's say for making that first crore, I invest roughly 70,000 rupees a month at 12% rate, then I will reach to a crore in about 8 years. Okay. And that first crore, you can take any amount of time, you can tweak the amounts, and you can reach to that first crore in whatever time. But just to elaborate upon the formula, once you reach the first crore in your life at 8 years, to reach the second crore, you will just need or you will just take 5 years. To reach the third crore, you will just take another 3 years, which means the first one is the toughest to achieve, which takes around 8 years. The second one takes around 5 years, and the third crore comes at around third year. And after your fifth crore, Samina, you will start adding a crore every year in your life. That's the power of compounding, and that's the power of your consistency and just playing the game long enough on the pitch.
Hmm. You never underestimate the power of compounding, Mohit. But let's talk about another common, a common objective that I think as an advisor you might be telling all your clients is the importance in the creation of an emergency fund. Now, this, of course, I completely understand is critical for somebody in their middle life. So, somebody in their 30s or 40s who has a lot more responsibility would definitely need an emergency fund because a loss of income or job could have a material impact. But for somebody in their 20s who, like I said, are footloose, fancy free, who probably live with their parents, don't really have to put food on the table, is an emergency fund still required? And if yes, should they be doing it? And how should they be doing it? Because your first paycheck that comes in is going to take some time to turn into a corpus that could support you for 6 months.
Absolutely. Look, I think you can never undermine the importance of having good provisions and good margin of safety at any age, whether you are 20 or whether you are 60. Each one of us have individual requirements at every stage in our life, and unless we have full cushion or full margin of safety, as I call it, it's not advisable to start investing into riskier assets. Even at age 20, I would reckon that the youngsters would have some requirements, or there could be some urgent requirements. Let's say I have an interview call, or let's say I have to travel somewhere very quickly, or let's say there is a break in my education and I have to fend for myself, or let's say there is an extra tuition which I need to take up to, or anything. It could be anything. It could be in any urgent requirement. So having that buffer always gives you good mental peace and good sleep. Finally, one has to always realize the objective of investments is not just to create wealth, it is also to give you peaceful sleep at night, right? So because you have that comfort and cushion that yes, everything is well taken care of. So irrespective of the age, my first thing would be that you create a corpus which is equivalent of your 6 months of your expenses. And at that age, the expenses are also fairly limited, and bulk of it, if it's taken care of by parents, then obviously you have to provision for your discretionary expenses, or if your of your or your education expenses or something like that, right? So take care of that. Create a small corpus through your savings for 6 months at least, which would just give you that buffer, and then go out and start investing into riskier assets or equity.
Right. Another important element that, of course, we discussed on the channel in our last episode was insurance. Now, back to the same thing, right? Insurance is critical as you get older and as you have more responsibilities and as your family gets bigger. Most young adults in their 20s are covered by insurance, either of their parents or their companies that they're working for. Uh, do you advise them to secure more in terms of insurance, health insurance, term insurance at this age? Is that recommended?
Look, it's a tricky one. Honestly, if you're not earning and you're dependent on your parents, then your financial underwriting cannot happen, which means you are not eligible to take insurance by your own self or in your own name, right? The first job will make you eligible for financial underwriting, and that's when you should actually cover your life or take a term cover. If you have dependent parents or any other loans, let's say an education loan or a home loan or something, then all the more reason that you should be covering it with a pure vanilla life cover and a term cover. One of the biggest follies which I see around is people mixing up investments and insurance, which is trying to take ULIPs or trying to take plans which have both investments and insurance linked. Those are of no use and honestly are highly avoidable, right? So the first thing which you should do is, once you start earning, with your first paycheck, go for a life cover. Health expenses or health cover again is something which is of paramount importance. Your company will obviously provide you that. In case it is not, then obviously you have to take it in your own name. But even if your company provides it, I would advise that everyone takes a small health cover on their own respective names, because you will keep hopping jobs, you will keep changing courses in life. Your health cover will keep shifting from one company to another, but you need something which consistently accrues you bonus points or no claim bonuses and everything, and just stays along with you when you need it the most. If you take it at an early age, it's always cheaper, right? So it's always good to take it in an early age, but don't take it before you start earning for yourselves. I don't think so it's required.
Mm. And is it something you would take on immediately on the very first month of your job, or is this an objective that can possibly wait a few months, if not a few years, until, of course, your life cycle in that sense changes?
Look, if you have a liability, which means if you have an outstanding home loan or an education loan is a higher probability event out here, then you have to cover that liability, because you can't let an unforeseen event burden your near and dear ones with that kind of liability. So you have to cover that. But I would say the first things foremost is the health cover. Please provision for a health cover, and then immediately, as and when your financial standing approves of it, go for a life cover, but don't delay it beyond like 6 months or 1 year of starting a job.
More than going to go off script for a minute and try and understand this, right? So we talked about insurance. What I want to ask you is, most people decide to add movable or immovable assets after a certain age. So like buying your first home, buying your first car, right? Some of these are objectives that can probably wait. What do you recommend? Do you think taking on a financial liability such as a loan to invest in an asset should be done earlier in life when you have lesser responsibilities, or should this be done later in life when you're earning more but also spending more? It's a bit of a catch 22.
Absolutely, it's a very very tricky one to answer, and honestly, I think a lot of emotions come into play when you decide this one. Look, you can categorize assets into two varieties. It could be a depreciating asset or it could be an appreciating asset. Your four wheelers, your what do you say, your Royal Enfields and your two wheelers or your Harley Davidsons, those are all depreciating assets, which means they don't appreciate with time. But a real estate will definitely appreciate with time. We can always debate about it whether it will appreciate the way your equities will appreciate or not. It perhaps won't, but it'll still give you some nominal appreciation, which is at least at par with the inflation, right? So if you're investing into an appreciating asset, then yes, let's say for your first house purchase, or because it's more of an emotional call for many Indians, right? I think we all grow up with that aspiration or dream of owning our own house and living peacefully out there, right? So that for first home, first peace of mind, I would still say that yes, provision for it. Don't overburden yourself with a very heavy loan. The loan EMI cannot be beyond 50% of what you earn every month or your cash flows every month. Try and curtail it to at least 50 or 40% of your monthly cash salary. That means you will at least have a comfortable living. Don't compromise on your monthly investments because you're taking a loan, and don't rush into it just because you've got your first job. Wait for 3 4 years out. You never know, if you have a transferable job, if you move cities, if you hop cities, then perhaps buying a real estate in a city where you don't stay can be a very bad option. So get a little settled in life. Wait for 3 5 years till your career is more stable, your cash flows are more stable, your location is more stable, and then go for that first house. Leveraging for that first house, yes, perhaps by all means do that. Don't over leverage. But leveraging for depreciating assets, which is buying those fancy bikes and cars, please, it's a highly avoidable thing, honestly. I think because everything which you leverage out will lose value within 2 4 years. It'll completely depreciate, and it won't accrue any kind of wealth or income to you. So that is absolutely avoidable. Don't take high loans, personal loans, or high cost loans just to buy those fancy things, or just to even do fancy trips, right? So I think those are highly avoidable items. But for your first home, because it's an emotional call, perhaps yes, financially I wouldn't be able to justify that because the rental yields in India are extremely poor. But yes, I think that just first house, maybe 3 5 years down the line when you're fully settled, you can look at a small portion of leverage on that.
So live within your means, don't live king size. I think that's what Mohit is trying to say. While all of those phrases sound very exciting and aspirational, keep it real, keep it frugal, keep it simple, save, invest, and then, of course, you will be far more comfortable 10 years out than some of your friends who are actually going out there and buying those gadgets, if not just motorbikes. And Mohit, it's always very easy to give this qualitative advice. What I think people struggle with is actually actionables. So, you want to tell me two or three simple ways that one can make a habit in order to save money and to keep peer pressure at bay? Because it's very tempting to get carried away, right? I mean, imagine us at 21. You want to buy the right clothes, you want to drive the right cars, you want to be at the right vacation. And it's almost as if you live once, right? But give me true advice that you would tell your 20-year-old self if you could.
Look, I understand the temptations are galore at that age, and it is extremely difficult to keep your feet on ground and your head placed well above your shoulders, right, at the right place. So it's very difficult, I understand. But finally, no easy solutions to this one. Discipline only comes with habits, and habits only come when you keep doing the same thing, repeated, boring stuff, month in and month out, right? I would honestly urge everyone just to follow one small rule and leave everything aside, which is 20% you pay yourself, which means that out of whatever you're earning, out of 100 rupees you're earning, the 20 rupees immediately day one, if your salary gets credited at 30th of the month, on 1st of the month, 20 rupees should go out from your account and should get invested into an equity fund, right? So if you do that, you will never ever go wrong in life, and you will only realize the benefit of this habit after 10 years have passed. And I understand 10 years is almost a lifetime at that age. But trust you me, at age 30 you will look back and you will see what you have created for yourself at that age. Then you will never find it very easy to pick up your first house, to go for that dream bike, to go for that dream vacation or that dream destination wedding. Everything will look extremely achievable just because you started at the right time, you started with the right habit. Only one small rule: 20% immediately goes out of your salary, gets invested. Keep the investment very simple. If be it just invest into an index fund and keep buying the index. You will never go wrong. That's about it.
That is just easy, practical advice, and 20% doesn't even sound too much. Very quick couple of more questions, Mohit. Um any sort of tax saving investments under Section 80C that you recommend for beginners in their 20s?
Look, Samina, it will all depend whether you opt for the new regime or you go for the old tax regime, right? If you are taking the HRA benefits, if you are doing those PPFs and PFs and all those kind of things, and perhaps maybe if your salary is let's say a little higher, the starting salary, right? Then you might want to go for the old tax regime because the benefits can really reap a little higher reward for you, right? At that age, then obviously the first and the foremost instrument has to be ELSS, which is over and above your PF investment. So PF is something which your company will deduct, which will automatically go. The limit under 80C is 1.5 lakh rupees. Out of that, let's say your PF which the company deducts is around let's say 50,000, then additional 1 lakh limit you can split between PPF and between ELSS mutual funds. I personally like both the instruments. I like PPF because it's a tax free sovereign guaranteed investment, more meant for a proper retirement corpus, and it's a fixed income instrument which never goes wrong, right? ELSS obviously it's has the lowest lock-in amongst every other tax saving instrument. The returns are fantastic, and if you lock in for 3 years, obviously it reaps you a very high return on that, right? So ELSS again is a great choice. So between ELSS and PPF, you have to split that ATC corpus.
Right. Mohit, very lastly, in this tech savvy world where everyone's only talking AI, if we need to connect with the 20-year-olds, we need to tell them what apps they can potentially use, which could help them track expenses, save mindfully, and also probably invest efficiently, because making it easy is probably one of the most important things to do.
Look, Samina, to be very honest, there are apps available in kilos and dozens today. Honestly, every investor or distributor worth his weight is getting a digital way of investing. So I think it is more about where you find your comfort and solace, where you, along with the app, also have some amount of assistance, which could be a telephonic assistance, right? But investment is not an easy journey. You would need someone who can just guide you, assist you at different times. It's not that you need it always. Once your portfolio is set, it will go on. But you will just need to have that small discussion once in 6 months or a year that, yes, everything is fine. Do I need to make a small tweak? Where do I put my additional allocation, right? So for that, I would suggest that you choose a platform which gives you all the convenience of a app of a digital platform, but you also choose where you have someone to pick up a phone and speak with, right? So there are multiple of these apps. You have Zerodha doing a great job in the country on that, which is the coin app. You have Grow, you have End Money, our platform, which is Moneyfront, and there are multiple others. Samina, as I said, there are by dozens and kilos you will find apps. It is about finding the right comfort and the right advisory team which will time in and time out again keep guiding you.
And keep your emotions in check. I think that's also very important, right? Investing is such a behavioral habit in that sense. But Mohit, we've got, of course, I can continue this conversation. We're completely out of time. So I'm going to take a few questions if we can from our viewers. Chintan Vasani writes in and he says, what would be a good fund for a lump sum investment? Should it be a flexi cap fund or an equity oriented? I mean, flexi cap is equity oriented, but let you answer that, Mohit.
Yeah, absolutely. Flexi cap is equity oriented, right? For a long term investment, it has to be equity oriented. It cannot be anything else but equity. My first take, if you ask me, my first preference for a long term investment where chances of you going wrong are fairly, as in relatively small, is an index fund, right? You choose a Nifty 50 index fund or you choose a Nifty 100 index fund, you definitely can't go wrong on that one, and you can just keep invested for 10 years, 20 years, 30 years, and just be there, right? So you never go wrong with that.
Hmm. Mohit, the next question I think you've answered in more ways than one, so I'll come back to these things question later. But Ashish Thakur asked, and I think this is a good question: is it better to invest in mutual funds, or would you recommend buying stocks?
Oh, that's a great one, and that's a perennial debate, and we can keep talking about it till cows come home. But honestly, Look, stocks and mutual funds is a personal choice. If you are on the screen, you can track the ins and outs of it. You are completely clued on. You are completely pegged onto the screen. Then by all means, pick up some good stocks if you can. My sense would be that if this is not your daily job, this is not your daily bread and butter, then give it to a professional who is doing it for his living, right? Which is where the mutual funds come into play. They are managing lakhs and crores of retail investors. They're doing it in a very, very regulated environment with a very professional approach and at a ticket size which is highly affordable to each one of us, right? So the first call of reckoning has to be mutual funds. Once you're comfortable, once you've spent 3 5 years with mutual funds, you've got a fair hang of market volatility, then by all means dabble into stocks and see if it really works out for you. Then create a different portfolio. But if not, then stick to basics, sticks to the boring stuff, which is mutual funds, and that's the one which is more long lasting and durable.
We also got one last question coming from Jatin, and Jatin says, I mean, this is what everyone's talking about. There was a headline today as well. Should I invest in Bitcoin or any other cryptocurrencies? I'm only in my 20s, with that disclaimer.
Okay, look, a disclaimer from my side, being a SEBI
I'm not
registered investment
20.
advisor. Sorry.
I said I'm not 20. That's a disclaimer.
Oh no, obviously that's pretty evident. But the other important disclaimer is, being a SEBI registered investment advisor, we cannot give any advice on cryptocurrencies or bitcoins. But as a concept, if you were to ask me, I completely believe in the concept of cryptos, which is a peer-to-peer transaction, which is where perhaps it's how the fiat currencies of the world were working, or why gold is what it is, why it is called a safe haven. But I don't know how long will this cycle of establishing a new digital currency will take place. It can take 50 years, it can take even 100 years. Gold took almost 500 years to become a currency, and then we have been following what do you say, paper currency for last 150 200 odd years maybe, right? So for any currency to get established as a means of trade, as an exchange unit, as a store of value, it takes a long economic cycle, right? So between that there'll be huge volatility, huge spikes, ups and downs. If you are really doing it, do it with proper advice, do it with a proper player, do it something which is absolutely legal and permitted and within the boundaries and precincts of your country. Know the taxes, know the ins and outs of it, and stay with the leaders. Stay with the leaders. There'll be many who will die by the side. There'll be many names which will come up which will look very fancy but will die by the side. So stay with the leaders and stay with proper advice. As I said, I can't advise on this one, so I'll just take a pause on that.
Hmm. Thank you, Mohit. It was good talking to you. Thank you for sharing your perspective with our young audience. In fact, this is advice anybody starting their financial journey can, use. You don't have to be in your 20s. It's never too late. Of course, just like it's never too early. But great talking to you. Thank you for a whole bunch of actionables, because I think it's so easy to give qualitative advice. It's when you actually tell people what they really need to do is when you actually encourage them to start the cycle of savings. But thank you. Have a good evening, and we'll see you soon.
Thank you so much, Amina. Thank you. A pleasure.
Thank you.